Good morning, everyone. Welcome to this webinar in our Ideas for Your ISA series. Sorry for the slight delays. We just sort out some gremlins in the tech. Shortly, we're going to be hearing from Sam Vecht about the BlackRock Latin American Investment Trust. The trust had a great year last year and entered 2026 looking well set up. Obviously, there's been a lot of volatility around the war in the Middle East, which may mean there's some value emerging. Maybe we'll hear about that. Sam is very keen to keep this as interactive as possible. So please, any questions you have, put them in the box on the right as soon as you have them, and we'll put them to Sam as they come in. So Sam, over to you.
Good morning, everyone. Thank you very much for being on the call. As was just said, let's make this as interactive as possible. There is only one thing more boring than listening to me for 10 minutes, and that's listening to me for 20 minutes. Love to have questions. I will take them as soon as they come in. I do not mind interrupting the flow because that will actually be of value to address the questions that people online have. I can't actually see the questions myself, thanks to even more gremlins in the technology. So I am relying on our good friends to relay them to myself as they come in. So I'm going to kick off now talking about Latin America. Obviously, everyone very much focused about war in the Middle East at the moment. The good thing about Latin America is it's quite a long way away from the Middle East, which possibly explains the fact that while beloved NASDAQ, beloved of so many people, is down about 5% year to date, emerging markets have done slightly better and up about 5% year to date. But despite the fighting, or because of the fighting and people looking at opportunities elsewhere, Latin America, the oft-forgotten part of emerging markets, is actually still up 13% year to date, really reflecting the fact that in a world that is worried about political strife, Latin America has challenges, as we will discuss, many challenges, but not really full-scale international wars. It's also the source of lots of commodities that at the moment are rather difficult to transport around the world. So if we actually go on to the slides themselves and just to remind people as to where we are on a slightly longer term perspective. Latin America is about 7% of global GDP. That's not an irrelevant amount, but it is only 0.1% of global indices. So all those people investing passively, and there are many, that is kind of how irrelevant Latin America is in your investment bucket. It's almost just not there. 7% of global GDP and irrelevant in most passive indices, but very important to us. It's home to about 300 companies that are really significant, with market caps over $1 billion. And it is not just about Brazil and Mexico. You can find big companies, big places to invest in at least 10 different countries. And I'm going to come back to that range of countries a little later. And just for people that like things technological, it's interesting to think about Latin America as being a place where digital payments are really taking the lead. If you go on the street in Latin America, as we do, and I don't know, some street hawker comes up to you in Brazil selling you a bar of chocolate, you will be paying for that not in cash, but you'll be paying digitally, phone to phone, in various ways. That's how you pay for things in Brazil. It's not how you pay for things in Europe. It's not how you pay for things in the UK, where we're still, much more of a cash-based economy. Remarkably than many countries in Latin America, but Latin America is in many countries very digital, unlike Europe. If we go on,
Sam, you mentioned over
Yes.
10 countries. We had a question about Uruguay. Is that one of the 10 countries? And do you have any plans to increase exposure on the back of their real estate boom?
Right, Uruguay is a really interesting place. In fact, I've been there in the last year. Uruguay, although it's a small country, is actually home to a large number of tech companies for both tax reasons and educational reasons. There are quite a lot of companies in Latin America that have sort of basically left Argentina or Brazil or other countries and set up in Uruguay. So while the population is small, innovation is fairly great. We have no direct exposure to the real estate sector in Uruguay because it's not really listed, but we absolutely do have exposure to some of the tech companies that exist in Montevideo that are listed typically, but not always, in the United States. So Uruguay is very much one of the places that we're looking at. And exactly to that point, people don't realize that there are several companies headquartered in Uruguay that have well over $1 billion in market cap. So yes, thank you. A great question there to kick off with, and please keep them coming. If you go on to the next page, in fact, if I go on to the next page, that will be even better. Here's a list of some of the countries that we are looking at. And while we don't actually have anything pointing at Uruguay, it is, as I highlighted, a place where there are companies in the tech sector that we're exposed to. So what is Latin America? It's a very big region, obviously extending from Mexico in the north all the way to Chile in the south. It provides an enormous amount of both soft and hard commodities. Second biggest iron ore producer in the world, for example, in Brazil, copper, lithium, soybeans, an enormous amount of different commodities coming out of Latin America. That is very efficient at producing commodities, but much more. A very large manufacturing base in Mexico. And while people are very worried about trade wars going on, even without real wars going on, I think it's fair to say whatever happens with trade in the world, the relationship between Mexico and the US will likely be better than the relationship between China and the US. So going forward, there's lots of discussion as to the exact place that tariff barriers get set up, the exact rates that countries get afforded by the US. But I think it'll be fair to say that the Americans are much happier dealing with the Mexicans, and the Mexican making whatever widget it is in northern Mexico and importing it into the US than they are with China. And that gives us the confidence that when we look at Mexico, as we highlight on the map, when it comes to manufacturing, when it comes to industry, there's a really tight relationship between Mexico and the US. Wages, obviously, in Mexico far, far lower than they are in the United States. And that's why, for the foreseeable future, we think there's going to be a lot of trade and an increasing amount of trade between Mexico and the United States. And as I said, not burdened by the same level of tariffs that many countries in Asia are. As we go into sort of other parts in Latin America, we had the pleasure of taking our investment trust board to El Salvador, of all places. A few months ago, we go on investment trips with the board of our investment trust every few years, and we went there because just to see a country that's renowned historically for fighting and war and criminality, and lots of changes going on there. Not all of them necessarily brilliant, but just to see a country in transformation, as is so much of Latin America. We spent time in Guyana, colored there in green, in northern Latin America, the northern part of just north of Brazil, a country known for its cricket, perhaps historically, or for its tourism, but now the world's fastest growing economy. That's right, Guyana, the world's fastest growing economy, completely ignored by most people, and that's even most people that look at Latin America. Lots of interesting opportunities potentially there. And then we go to some of the more mainstream countries in Latin America, Brazil, and Argentina and Chile and Peru and Colombia and Ecuador, all these places yielding a variety of opportunities, often missed by people. And it's worthwhile remembering that the majority of Latin America, investment-wise, is roughly where it was 20 years ago. So share prices today in Latin America, often where they were 20 years ago. The countries have changed, the cities have changed, the people have changed, but this has been a part of the world that's been desperately out of favor for a very long time. And we think...
So we had a question on what the questioner calls the Trump's gunboat diplomacy. Has that impacted valuations or at all in the region, of throwing up any opportunities or any changes to how you're viewing the region?
Right. Yeah. So one of the interesting things that's actually happened in Latin America, and we perhaps touch on it in a slide. Let's go on to this slide as a good answer to the questioner's question. one of the things that's interesting about spending a lot of time on the ground in Latin America is one actually gets to see what's changing. So this is a slide just highlighting some of the places we've been to. I'm going to skip 3 more slides just to address the questioner's question. These are some of the wonderful leaders and not so wonderful leaders in Latin America. And the general trend that we've seen in Latin America over the last year is for parties that are more market friendly, not necessarily people friendly, but more market friendly to come to power. So obviously, we had big change in Argentina a couple of years ago. Everyone thought that Milei was a very strange person. People making all sorts of nasty comments about him. If one looks at the Western media when he was elected, yet what he's been able to achieve in Argentina has been remarkable. Inflation coming down, the currency stabilizing, the stock market going up. Doesn't necessarily mean you want to invest there, but the gentleman has achieved far more in Argentina than any of his predecessors did. Argentina known for winning football World Cups and destroying investment opportunities. I think under him, they probably won't win another World Cup, but it may be a very good place to invest at the right price. Similarly, Bolivia, a country which was in sort of a socialist heaven, well, in the eyes of the leaders, for a long period of time, has finally elected a sensible leader. Similarly, Chile actually runs slightly better under socialist regime for the last few years, had an election a few weeks ago and has moved to the right under Cast, a gentleman I've met previously. Again, much more market friendly. Seen similar changes in Costa Rica, El Salvador, Peru. So right across Latin America, we've seen more market-friendly regimes coming in. And how does this relate to the gunboat diplomacy? Obviously, we've seen changes in Venezuela. Venezuela is not a country currently that we have any exposure to. It's a country that historically we have had exposure to until the Chavistas completely destroyed that country. It's entirely possible that in the next year or so, we will once again have exposure to Venezuela as the gunboat diplomacy, as labeled by the questioner, actually has an effect, and Venezuela gets removed from various sanction lists, and perhaps Venezuela's very untapped energy resources, underdeveloped and underinvested in because of the rather difficult government relations for a long period of time, will really become a very big opportunity. A massive economy, Venezuela, an enormous potential, and just completely wasted for the last 20 years. So the gunboat diplomacy isn't always ideal, but to the questioner's question, really throwing up opportunities. And who knows what's going to happen in Cuba, another country that has been off limits given sanctions for a long period of time, potentially changes there. And you can even see that in some of the comments made on national TV. I don't know how many people watch Cuban national TV. I wouldn't recommend it. It's not very exciting. But the president coming out on national TV at 7:30 in the morning, about 2 Thursdays ago, basically saying, well, perhaps we're going to be improving relations with the United States, something that people really didn't think would be happening for a long period of time. So the whole part of Latin America is really seeing significant change, often very market-friendly change. As I said, it comes on the back of 20 years where the stock market has gone absolutely nowhere, and everyone has much preferred to invest in exciting things that now perhaps look a little less exciting. That knowledge economy that everyone's been looking at in parts of Asia and in Western Europe, and even in the software firms in the United States, perhaps being questioned how sustainable some of those business models are. A lot of what Latin America has is considerably more sustainable. Please keep those questions coming. I'm just going to go back, if I have the technological ability, to where I was. And that is over here. Testing our thesis on the ground, really, really important. We don't invest in a company unless we met them typically 5 or 6 times. We insist in meeting companies, customers, suppliers, and competitors. We insist when we go to a country, we're investing in a society. We're not just investing in a corporate. There's no point just meeting the CFO in their beautiful corporate offices. You've got to get out, understand society, and that's why when we go to these countries, we meet politicians, typically of the far left variety. They're much more interesting to meet than hearing the people that want to be market friendly. We meet journalists, we meet diplomats, we meet students. Students are really interesting to understand, do they see a future in their own country? We meet lawyers, accountants, small business owners, everyone who plays a part in society, because that's really important for us. We have a long-term relationship with the people in these countries, and that gives us a really, really good insight to what's going on. And as I was mentioning earlier, it's about looking across the totality of Latin America, not just Brazil and Mexico. It's such a broad, disparate, interesting continent to explore. So much opportunity in so many different sectors, and that's what we spend our time doing. So I should also add, it's really important, it's not just about seeing the companies. We have to be fairly confident that what they are saying they're doing is what they're doing. All the companies we invested in are audited by one of the big four. Obviously, so was Enron. But, it's very important for us to do our due diligence on the ground. But that said, we do not want to be based on the ground. Having people based on the ground just means you have a collection of lobbyists for that country. You have people based in Brazil, they become the Brazilian lobbyists. They never want to be bearish on their own market because it gets rid of them if they are. You have someone sitting in Chile, and let's say they had the view that one shouldn't invest in the market for the next 3 years, which at some point would probably be true. They would put their jobs at risk. And therefore, having people sitting locally who just become lobbyists for their own sector or country isn't actually a great idea. But we do spend a lot of time on the ground, and that's what we've been doing for the last 25 years. The time has flown by because we love our jobs, but it has been the last quarter of a century that we've been going around to various places that sometimes other people feel scared to travel to. I'm assuming there are no further questions at the moment.
We have one or two.
Oh.
There's one about the Mercosur deal. Is that going to be positive for the region? The EU-Mercosur deal, I think, is close to being signed.
Yeah, definitely at the margin, trade deals are helpful. The extent to which they move valuations and move share prices initially is always slightly questionable, and who the relative winners are. Trade deals are helpful, and I think I just have to look at it in the broader context of what's going on in the world today, where you basically have the world split into three. Even before we had the war in the Middle East, you've basically got a Western bloc, call it the EU, the US. You've got an Eastern bloc, call it China, Russia, Iran, and a few others. And the guys in the middle who are able to trade with both sides are real winners of this more split up world than we've had. So the world, I would argue, 2026 for the next 10 years looks very different to the world that we had, let's say, from 2006 to 2026, geopolitically, economically, socially, in so many regards. And I think the countries in Latin America, because they are able, they've got good relationships, both with West and with East, for lack of a better term, in both cases, they're actually really winning out of it. And you can see in terms of the way that the Brazilians, the Mexicans are able to trade both with China and the US without annoying either side. I think that's important. Mercosur trade deal also pretty helpful. Was there another question?
Yeah, so have you made any changes to the portfolio after the outbreak of the war? For example, have you increased oil producers?
Yeah, no, we increased oil producers before the war broke out. That was the time to be doing it, and thankfully we did. So yes, we added to a couple of oil names in January and in early February, actually. So that's what we did. And actually, after the oil prices come up, we've actually trimmed our energy exposure very slightly. So it's really important for us to try and anticipate events, not to react to events. What we are doing, we haven't actually done that much in the portfolio because, as I was saying, this part of the world hasn't really been that affected. But at the margin, there have been certain stocks that have been a little beaten down, not very beaten down, since the war broke out. And we've been adding to those names. And as I said, at the margin, some of our energy exposure we've actually trimmed in the last week or so, just because we don't think that this war carries on forever, but we do think the ability of Latin America to produce commodities at the cheapest level globally is really attractive, and the fact, the obvious point, that it's very unlikely that we're going to have wars between the countries in Latin America. Obviously, there's violence inside countries in Latin America, and it's not that there are no risks in Latin America. There's significant risks in Latin America, but wars between the countries in Latin America are generally unlikely, and even those but which look a bit more likely. There are concerns about Venezuela and Guyana now looking a little less likely. We're not going to rule out wars. These are emerging markets. Remember, that's really important. This is not Scandinavia, but we just think it's a little less likely in Latin America than it is elsewhere in the world. Any other questions at this point?
Yeah, on China, how important is China to the Latin American investment case with respect to its demand for commodities?
Great question. Yeah, it's important, but it's not the only thing that's important. So obviously, lots of commodities do go from Latin America to China, but lots of commodities go from Latin America to Europe, to Saudi Arabia, to the US, obviously very much so. So it's important, but it's not the be-all or end-all. Actually, it's a really broad pie of countries that benefit from Latin America's exports. Obviously, it's not just commodities Latin America is exporting, not just hard and soft commodities, also correction of industrial exports as well. So China important, and it would be fair to say that if the world went into a global recession, that wouldn't be good for Latin America either, but it's not just a China play. So
we do have a couple of questions that I think are kind of aiming at the same idea. So in terms of how uncorrelated are the different equity markets, and what sort of role do you think the holding Latin America plays within a broader portfolio?
Yeah, really good. Okay, let me take the second question first. I think Latin America, if I think about a global portfolio, and obviously everyone, this is not for me to say, please speak to your independent financial advisor for everyone's own specific investment needs. But if I sort of think about Latin America, I just go back to where I started. 7% of the world's global GDP, completely irrelevant in global indices. And that can't be right. And it wasn't always the case. If we go back 10, 15 years, 20 years ago, Latin America was, or even longer, Latin America was like 25, 30% of global emerging markets. Today, it's about 7%. So what we've actually seen over the last 20, 30 years has been the rise in indices, not necessarily as a percentage of GDP, not necessarily as a percentage of world trade, but we've seen the rise in index providers, manufactured indices, a big rise in certain countries and a collapse of the Latin American weight. So I think it's very important one disaggregate markets from economies because they don't always move together. So I think on a going forward basis, it would make sense that there will be some realignment whereby Latin America, which is also a significant proportion of world profit, as well as a significant portion of world GDP, we will see its weighting in indices move towards those percentages that we see for profit and for GDP. So my guess is over the next 5, 10 years, we will see Latin America's proportion of world GDP and world profits not move that much, but I do think its proportion in world indices will move up very significantly. It's a very cheap region today. We'll come on to that in a second. And I think that is sort of the medium-term driver. On a day-to-day basis, these markets are volatile. They're volatile because they are not as liquid as the United States. They are volatile because domestic capital flows are small compared to international capital flows. So on any given day, there could be high correlation between these markets and what we're seeing elsewhere. But for investors, and really all investors should be looking on a medium-term basis, we think that volatility will probably come down over time as, number one, the countries develop their own capital bases, but also as we sort of see that longer-term trend where the Latin American proportion of profits and GDP is better reflected in indices as these indices actually finally rally after 20 years. Sorry, and the first question was, you asked me two there. What was the first one? Sorry.
Well, the first one was about the sort of internal correlation. The second one was about in the portfolio. So I think you probably covered.
Right. Yeah. Internally, these markets are fairly correlated towards each other, but not massively so. So, for example, countries like Colombia and Chile and Peru are less correlated with with Brazil. Mexico slightly more so. Actually, what you see more is correlations within sectors than within countries. So going back to your point about oil, with oil price rising, lots of the energy producers across the region have gone up at the same time. Similarly, let's say some of the materials names, let's say the gold names have all gone down at the same time, or gold and precious metals have gone down at the same time. We don't actually really have very much exposure to that area. We thought gold and precious metals actually gone up a little too much, and we were selling these exposures in late 25 and early 2026. If we go on to a market outlook, and I think this is really quite important, what we have here is just showing at the top slide sort of PE ratios for Latin America over a long period of time, not over the last day or so, but over the last 20 years. And what you can see, Latin America now trading at about 12 times earnings. It's rarely been this cheap. You can see over a long period of time, it has been cheaper, but rarely been this cheap. But look at that gap versus the United States. If we go back to the left-hand side of the top chart, you can see from about 2007 to about 2013, and actually if we go back all the way to 2000, the green, orange, yellow lines kind of in the same place. Sometimes one is higher, sometimes the other is higher, but emerging markets trading at roughly the same multiple as Latin America and as the US. And what's actually happened over the last 10 years is there's been this massive chasm opening up between the US on the one hand, which apparently can do no wrong, and everywhere else, which can do. And I think what people are questioning in 2026, and we're going to see the US multiple fall, is, when you have a president of a country questioning the independence of a central bank, when you have the president of a country questioning the Supreme Court, challenging institutions, telling companies where they should be investing, telling defense companies how they should be using their profits, publicly demeaning various CEOs and journalists, I think people might begin to question what the correct multiple for such a country is. And I think we're probably beginning to see a period of time where for the last 20 years, US, nothing to do with Trump, regardless of politician in charge, US importance politically and economically globally has been on the decline. It's definitely the most important country in the world from a geopolitical standpoint, but its relative importance has been declining. Yet its market cap importance keeps increasing, or has kept increasing. And that dissonance is really strange to us. The fact that on the random way that indices are constructed today, its market cap weight keeps going up, yet its political and economic importance, relative importance, keeps going down, for us is something we don't really understand. And therefore, our guess is that if we reconvene the people on this call in 5 years' time, we will see a convergence of those green, orange, and yellow lines, the top half of this slide. And you can kind of see on the bottom side is just how expensive or cheap markets are relative to their own history. So the US, the green line, is at the 87th percentile. So it's pretty much never been this expensive. Latin America exactly midway, not quite midway, cheap at 43%. Emerging markets, a function of where Taiwan and India are trading, rarely been this expensive either. So I think what's really interesting is Latin America stands up really well on a valuation basis. If we go down one more slide, just to remind people, Latin America has the highest real rates in the world. So in terms of what that means is, you have your interest rate in a country, which in Brazil is about 15%. You look at where inflation is, and you look at the difference between the two. Real rates in Latin America are really, really high. Our view is that these rates will fall during 2026. Can you hear me? Just checking. You still hearing me, Tom?
We can hear you fine, yeah.
Okay, sorry. Real rates are likely to fall significantly, and that with real rates falling in Latin America, we think that will be a really big boost to the stock market. Real rates, as I said, in Brazil, the highest in the world. In Mexico, also very, very high, way above what they are in the United States and the United Kingdom, for example. We think those real rates will fall during 2026, and that will be a big support to the market. I pause in case there are any questions.
Has the picture changed at all with the kind of energy price shock due to the conflict?
The energy price move, obviously oil price is up about from 55 to 95 during this month. Latin America is generally, because it produces energy, is less affected than, a place like Korea or Taiwan or India or China, because obviously those are big energy importers. At the margin, Brazil is actually trying to help some of their consumers with the higher oil prices. But the broad picture for Latin America hasn't massively changed. One country that is impacted by higher oil prices, obviously, is Chile, which doesn't have much energy itself. Obviously, got a lot of copper. We don't have that much exposure to Chile. To be clear, it's not our view that these oil prices stay that high for that long. But on a relative basis, once again, Latin America does relatively well out of higher oil prices, a lot better than most parts of the world. And this is the slide I put earlier of the various leaders, their lovely sashes they seem to wear, their national colors draped over their right shoulder. We don't really get such beautiful sashes in Europe, but I think it is interesting, as I highlighted earlier, that these countries generally are moving in a more market-friendly direction. Now, what's important this year is we've got 3 further elections this year. We're having Colombia coming up pretty soon. It's been run by a left-wing leader who's really damaged the country, not because he's left-wing, just because his policies have been bad over the last 4 years. He will not be, he can't stand for re-election. It's possible that Colombia will move to the right in the election coming up in just a few weeks' time. Peru probably will stay in a probably more market-friendly environment. And then the really big election in the second half of this year is in Brazil. President Lula is 80 and not in the greatest of health. And he is now trailing in the polls to a right-wing contender who is young and vibrant. And there's just not a great track record of 80-year-old people and not the greatest health winning democratic elections. So while Lula's actually done quite a good job in Brazil, I think if there were to be a move to the right in the election upcoming in October and then in December, different first round, second round of the election, I think the market would take that very favorably. No strong view as to whether that happens, but if it did see Lula losing this election, I think the market could be up very strongly. And that's important to highlight.
Just to say, we have one final question that's come in from the audience. So if anyone is in the audience and has another question, please do put it now, because we've got five minutes or so left. Sorry, Sam.
Yeah. If we go down another slide, just to remind people of, Latin America had a good run so far over the last few months, but again, not radically different to where we were 20 years ago. And then just in terms of positioning, a lot of exposure in Brazil, just so much opportunity. It's not just because the region is not just Brazil, but it's just so much opportunity in Brazil today after 20 years in the doldrums. Opportunities in so many different sectors. I think this is more interesting. We just look at the range of sectors in the fund, really very diversified: financials, materials, industrials, consumer, all roughly 20%. And that's quite cool if you think about it. Very diversified between those 4 different pools of money. As I said, consumer 20, looking at it, 22%, industrial 16, materials 22, financials 25. It's a very diverse collection. The one thing that there isn't lots in Latin America is actually IT. And I'm not sure whether after 20 years of going up and now big questions around what AI does, whether IT is the best place for people to be exposed. In terms of the relative weightings, we're not great fans of utilities. We don't find that such companies which are regulated in Latin America always do well. We're not anti them, but just much bigger opportunities elsewhere. Yes, Tom.
Yeah, so I had a question about how you manage the portfolio. So how much does the macro environment of the country influence allocation compared with the individual company characteristics? How do you weight those two things?
Yeah, really good question. It's really important for us to actually consider both. And the story about Latin America is if one has a negative view on politics, macroeconomic, fixed income or currency, forget the equity. Because when the currency goes down 10, the market goes down 20 and you lose 30%, often overnight. This is not like the United Kingdom. Pound strength means market falls and vice versa. In Latin America, these things are very, very highly correlated. So it's critical for us, to have a positive view on the country. So take Colombia at the moment. We have next to no exposure there because we've got concerns about the currency. We've got concerns about the politics. Perhaps that will change when there's an election. So if there's a country which we aren't comfortable with the top down, it is not going to be there. But at the same time, for us to make an investment, we actually have to like the companies. We have to like what management are doing. We have to like the valuation. So it's always a combination of top down and bottom up. About 60 to 70% of our risk is bottom up, but there is 30-ish% that is top down. So they're both actually important. I think this is interesting.
I had a question.
Yeah.
Sorry, on the dividend. So the fund pays a healthy dividend. Do you select companies for dividends specifically, or are you selecting for total return?
No, we're selecting for total return. Now, this is not an income fund. We have a healthy dividend as a function of how cheap these markets are and how much these companies pay out. We are not an income fund. We don't need to be an income fund. We can generate total return much more happily, and that continues to be our focus. The other thing which is interesting, I'm aware that we're running out of time, just to see how the sectoral weights have moved over time, real diversity here. And that's what we're trying to highlight here. It's just to show, we do make active decisions. This is an actively run fund. And there can be times where, for months on end, we don't do very much. And then suddenly there'll be some great opportunities. This is active management. That means there are times when we underperform, but such a broad range of opportunities across so many sectors, which is one of the great things that we really enjoy about Latin America. So I have come towards the end of my slides. There's an extremely exciting risk warning slide, which I would encourage everyone to read because, and I'm going to say on this because people don't realize, Latin America is a risky place to invest. I'm really bullish. I think this is a great place for people to be thinking about today, but it is risky. And one should never forget that. The most dangerous time to investing in emerging markets is when people think there are no risks. But because these markets have gone pretty much nowhere for 20 years, because they're so cheap, relative to Western markets and relative to their own history, because there's this geopolitical story, even before the war, and even more so with the war going on in the Middle East, because we're seeing political change on the ground with countries moving to a more market-friendly regime, because there's such a range of companies in so many different sectors, and because, as we started off with, 7% of world GDP, 0.1% of global industries, we just think this is just a great place to be looking at, providing one has a medium term outlook. Do not be investing in Latin America on a 1 month or 3 month basis. It will be extremely volatile. If we think about our emerging market funds, not just our Latin American funds, because we run both, we are massively overweight Latin America in our emerging market funds today. Double weighted in some funds, triple weighted in Latin America relative to the index weight. And that really reflects the fact that we see this as one of the best places to invest in across emerging markets, but it does not mean there are no risks. There are significant risks, and we have to remind people of those. Tom, any final questions?
There is one, yeah. Unfortunately, you ended on such a great positive note, so it's a bit of a negative. But how would the region react if there was a recession in the USA? Is it very dependent on the USA economy remaining strong?
Yeah, that's important. No, it's important to address the question. Mexico would do badly. Mexico would undoubtedly do badly if there was a recession in the United States. The whole world would do badly. But actually, Brazil and the rest of Latin America is a fairly enclosed economy. And people sort of forget. Brazil, I think it's the 8th biggest economy in the world. It's fairly insulated. Yes, they export stuff, but they're their own massive economy and own continent. And of all the large economies in the world, Brazil is actually probably the most insulated economy to a US recession. So the market would go down initially because on fear, but on an economic basis, Brazil would actually be fairly defensive. On an economic basis, Mexico far less so, but other countries in Latin America would again be in the Brazilian category of being fairly defensive. So if there was a US recession, there'd be a world recession, all stock markets would come down. But I would say that those markets that are already really expensive and are trading at all-time highs and have gone up and everyone has been looking at would probably have the greatest risk. Who knows? Let's hope there's not going to be a recession. But if there were, actually Brazil may actually do relatively well.
Fantastic. And that takes us to the end of the questions. Thank you very much, Sam, for the presentation and for your full answers to all of those questions. Thank you very much to the audience for your interest. Hopefully that was useful. Hopefully we will have a replay with the slides up on our website soon, which you should be able to access. So with that, I just wanted to flag that we have another presentation this afternoon on a very different subject on Seraphim Space. We'd love to see you there. But Sam, thanks very much for your time. Yep, see you next time.
Thank you. Thank you.
Bye-bye.